You are looking at the most expensive construction project in human history, and the tenants are not moving in. It is December 6th, 2025, and the stock market is trading at all-time highs based on a single promise that artificial intelligence will generate trillions of dollars in revenue starting any day now. But I have pulled the earnings transcripts, the electricity usage reports, and the inventory data from the supply chain in Taiwan and South Korea. The story they tell is not one of exponential growth, it is one of exponential waste. We are staring at a capex air pocket. This is the moment when the companies stop buying chips because they have nowhere to put them and no software to monetize them. Welcome to the investigation into the AI hardware bubble. Before we expose the revenue gap, I need you to lock 3 doors in your mind. Door number 1, who is the bag holder of last resort? It is not the retail investor this time. It is a specific type of corporate entity that has overordered by double. Door number 2, what is the utilization rate secret that data centers are hiding? Because if this number leaks, the stock prices of the hyperscalers crash 30% overnight. And door number 3, what is the energy ceiling that physically prevents AI from scaling any further, regardless of how many chips you buy? Keep those doors locked. Let us start with the inventory build. For 2 years, the mantra was scarcity. You could not get a GPU if you begged. Today, I am looking at the secondary market data. The premiums for H100 and Blackwell chips have vanished. In fact, there is a glut. We are seeing brokers in Shenzhen offering slightly used chips at a discount. Why? Because the startups that bought them in a panic in 2024 have burned through their cash and are liquidating hardware to pay rent. This is the first crack. When the secondary market floods, the primary market orders get canceled. I tracked the book-to-bill ratio for the semiconductor equipment manufacturers. It is rolling over. The orders are slowing down, but the factories are still running at 100%. This leads to an inventory write-down cycle that will devastate earnings in Q1 2026. Drop a comment below, one word, bubble or breakthrough. Do you use paid AI tools daily? Yes or no? Let me know. Now let us look at the return on investment problem. The hyperscalers, primarily Microsoft, Google, and Amazon, have spent over $500 billion on infrastructure in the last 18 months. To justify that spend, based on historical software margins, they need to generate roughly $600 billion in new incremental revenue annually. I combed through their latest 10Q filings. The actual AI-specific revenue is a rounding error. It is less than 50 billion combined. They are spending $1 to make 10 cents. This is not a business. It is a charity for chip makers. The shareholders have been patient because of the fear of missing out. But patience is running out. We are seeing hedge funds rotate out of hardware and into utilities. Why? Because they know the build-out phase is ending and the digestion phase is beginning. Digestion is Wall Street code for dead money for 2 years. You can understand this in 30 seconds. Imagine a taxi company buys 1 million Ferraris because they think everyone will want luxury rides. But it turns out, people just want to get from A to B cheaply. Now the taxi company has a parking lot full of depreciating Ferraris and no customers. That is big tech right now. Now let us peel back the depreciation bomb. This is an accounting nightmare. These chips are not like buildings that last 50 years. They degrade. They become obsolete in 3 years. This means companies have to depreciate them aggressively. A $500 billion spend means a $150 billion annual depreciation hit to earnings. This hit is about to show up on the income statements. It will crush net income. The PE ratios are fake because the E, earnings, is about to get slashed by depreciation. And this leads us to the skeptic corner. You say, but AI is the future. It will change everything just like the internet. I agree. The internet did change everything. But if you bought Cisco in 2000, you lost 80% of your money and it took 15 years to break even. Being right about the technology does not mean you make money on the stock. The valuation matters. And right now, the valuation assumes perfection in a world that is messy. Let us look at the power constraint. This is the hard physical limit. I analyzed the grid connection queues in Northern Virginia and Ireland, the data center capitals of the world. The wait time for power is now 5 years. You cannot just plug these chips in. We have warehouses full of servers sitting dark because the local utility cannot supply the gigawatts. If you cannot turn the chip on, it generates zero revenue, but you still have to pay for it. This stranded capital is the silent killer on the balance sheet. And the solution, which is building nuclear reactors, takes a decade. The market is pricing in immediate growth, but physics is dictating a delay. This mismatch is where the crash happens. And finally, look at the insider sales. I track Form 4s every night. The CEOs of the chip companies are selling. The CEOs of the software companies are selling. They are not buying their own hype with their own money. They are selling to you. When the insiders rush for the exit while telling you to buy the dip, you know what time it is. It is closing time. In part 2 of this investigation, we are going to open the doors on the utilization rate scandal, and I will show you exactly how the cloud revenue numbers are being manipulated to hide the lack of demand. The bubble is not leaking, it is bursting. Now let us dissect the revenue circularity, because this is the Enron structure of 2025, just with better PR. I dug into the venture capital deal structures of the last 12 months and found a pattern called round tripping. Here is how it works. A massive hyperscaler invests $1 billion of cash into a hot AI startup. The headline says, strategic investment. But the fine print of the deal requires that startup to spend that $1 billion exclusively on the hyperscaler's cloud computing services. So the money leaves the big tech balance sheet, goes to the startup, and immediately comes back to the big tech income statement as cloud revenue. It is a wash trade. It creates the illusion of growth, but no net cash was generated. It is simply moving money from the left pocket to the right pocket to pump the stock price. I estimate that up to 30% of the reported AI cloud revenue is this type of incestuous recycling. When the startup runs out of cash and goes bust, the revenue vanishes instantly. This is the air pocket I warned you about. And this brings us to the utilization rate scandal from door number 2. The public narrative is that there is a shortage of compute. The reality inside the data centers is ghost clusters. I spoke to engineers at 3 major cloud providers. They told me that while the GPUs are rented, they are sitting idle 60% of the time. The companies renting them are hoarding them just in case, or they are struggling to get their models to work. But here is the kicker.
The cloud providers are counting booked capacity as revenue. But if the customer goes bankrupt or cancels the contract because they aren't using the chips, that future revenue backlog evaporates. We are seeing a spike in capacity release on the dark web markets. Startups are trying to sublease their GPU time for pennies on the dollar because they cannot afford the monthly burn. This collapses the pricing power of the hyperscalers. If you can get compute on the secondary market for half price, nobody pays the list price to Amazon or Microsoft. Margins compress, earnings collapse. Now let us look at the enterprise adoption wall. The bull case assumes that every Fortune 500 company will pay $30 a month per employee for AI copilots. I pulled the renewal data for the early adopters. It is ugly. Companies are finding that the productivity gains are real for coders, but negligible for everyone else. They are cutting their seat counts by half upon renewal. This is churn. And churn is death for a SaaS valuation model. If the take rate stabilizes at 10% of the workforce instead of 100%, the total addressable market shrinks by 90%. The stock prices are priced for 100% adoption. The math implies a crash. And this leads to the sovereign AI bluff. We were told that nations like Saudi Arabia, France, and Japan would spend trillions building their own sovereign clouds. But I looked at their fiscal budgets. They are broke. They are dealing with debt crises and aging populations. They are canceling these massive orders quietly. The sovereign bid was a sales pitch, not a reality. Now let us open the 3 doors. Door number 1. Who is the bag holder of last resort? It is the neoclouds.
These are the specialized GPU cloud providers that borrowed billions of dollars against their chips to build data centers. They are leveraged to the hilt. When the rental price of compute drops, they cannot service their debt. They will default. And when they default, the banks seize the chips and dump them on the market, crashing the price of the hardware. It is a classic liquidation cycle. Door number 2, the utilization secret. The real utilization rate of AI clusters globally is likely under 40%. The rest is shelfware. This means we have overbuilt capacity by double. We do not need more chips, we need to turn off the ones we have. And door number 3, the energy ceiling. It is not just about power generation, it is about heat dissipation. The new Blackwell chips run so hot they require liquid cooling. Most existing data centers cannot handle liquid cooling. They are air-cooled. Retrofitting them costs billions and takes years. So the chips sit in boxes. This physical bottleneck stops the scaling law. You cannot just make the model bigger if you cannot cool the silicon. The physics is saying stop. And this brings us to the master key. The master key is the application gap. In every technology cycle, infrastructure is built first. Then apps are built, then profits arrive. But in this cycle, we built the infrastructure to the moon, and the killer app is still just a chatbot. There is no AI application yet that generates revenue comparable to search or social media. Until that app appears, the infrastructure is a bridge to nowhere. The market is pricing in the destination, but we are still stuck on the bridge, and the toll booth is expensive. So what happens next? We are going to see a capex cut announcement from a major hyperscaler in January 2026. They will say they are optimizing spend. That phrase will be the pin that pops the bubble. The entire semiconductor supply chain will re-rate lower. If you are holding chip stocks thinking they are a safe haven, you are standing on a trap door.
In the final part of this investigation, I will give you the specific short signals to watch and the one sector that actually benefits when the AI bubble bursts, because capital will rotate back to the real economy. The hallucination is over, the hangover begins, and the first place looking for a refund is the energy sector, because while the AI stocks are a bubble, the energy demand they created is real and permanent. Even if the chips are turned off, the grid needs upgrades. We are seeing a massive rotation of capital from bits to atoms. The smart money is selling the software companies that have no moat and buying the utility companies and the nuclear fuel producers that hold the keys to the power socket. This is the real economy revenge. In a high-interest rate world, you cannot eat code and you cannot live in a virtual reality headset. You need copper, you need uranium, and you need healthcare. The sectors that have been neglected for a decade are about to outperform the tech sector for the next 5 years. This is the great rotation. I analyzed the price-to-earnings ratios of the utility sector versus the tech sector. The spread is at a 20-year wide. It is a coiled spring. When the tech valuation compresses, the utility valuation expands. It is a mathematical seesaw. Now let us address the specific short signals you need to watch in January 2026. Watch the capex guidance line in the earnings reports of the big 3 cloud providers. If they use the word digestion or optimization or pause, that is the trigger. The algorithmic trading bots are programmed to sell instantly on those keywords. A 10% cut in capex guidance translates to a 30% drop in the equipment supplier's revenues. It is a bullwhip effect. Also watch the insider selling to buying ratio. If it crosses 500 to 1, which it is approaching now, that is the smoke signal.
And finally, the master key to this entire cycle is the productivity paradox. We were promised that AI would double global GDP by making everyone twice as productive. I looked at the global productivity data for 2025. It flatlined. There is no macroeconomic evidence that AI has moved the needle yet. If the macro productivity does not rise, corporate profits cannot rise enough to justify these stock prices. The master key is realizing that we priced in the revolution 10 years too early. The revolution will happen, but the bubble has to burst first to clear out the malinvestment. Just like the fiber optic bubble of 2000, we built too much fiber, it crashed, and then 10 years later, we finally used it all. We are in the year 2000 of the AI cycle, not the year 2010. So what is the play? You stay away from the hardware suppliers who are swimming in inventory. You stay away from the unprofitable software wrappers that are one update away from being Sherlocked by Apple or Google. You look for the pick and shovel plays in the physical world. The companies that build the cooling systems, the companies that mine the copper for the grid, and the companies that own the land where the data centers sit. Land is the ultimate constraint. You cannot print land. The real estate investment trusts that own data center properties are the landlords of the AI revolution, and the landlord always gets paid even if the tenant goes bust. This is not financial advice. This is a sanity check in a market gone mad. The hype cycle is over, the execution cycle is hard, and the valuation reset is imminent. Do not get caught holding the bag when the music stops and the lights in the server room go dark. Stay skeptical, stay grounded, and remember that a slide deck is not a business model. End of transmission.